I'd like to start by telling you a little bit about the Federal Reserve, just to level set why I'm here. But then the most important part of my talk actually is going to be listening to you. So we're going to have people out there with roving mics, and I want to spend most of this time having you ask me questions or you give me comments, because honestly, as much as I'm here to share with you messages about the Federal Reserve and what we're doing, just as important or more important is for me to hear from you what's happening here in the local economy in South Dakota and in Sioux Falls. And let me tell you why. So what is the Federal Reserve? The Federal Reserve is our nation's central bank. Congress has given us what we call a dual mandate, which is generally speaking, we adjust interest rates to try to achieve two different goals. One goal is what we call stable prices. You can think of an economy that's not overheating and not growing too slowly. Think about stable growth. Second mandate is maximum employment. That means everybody who wants to be able to get a job is able to get a job. And sometimes those two things are in conflict. Sometimes they work together. Now, so why am I here? If you go back in our nation's history, back to the founding of our country always hated the idea of having a central bank because a central bank sounded spooky. A bunch of bankers in a dark room doing God knows what. It all sounded very undemocratic. So Alexander Hamilton, one of our founding fathers, created the first central bank of the country, and it lasted a couple decades, and then they got rid of it. They said, fine, enough of this. We don't want it anymore. And then in the 1800s, the late 1800s, our country was hammered with banking crises, financial panics, culminating in a really big one, the banking panic of 1907. And then Congress said, well, even though we don't like it, I guess we need to have a central bank. But if we're going to have a central bank, let's not have it concentrated in Washington, D.C. So one of the things that's unique about our central bank is that, yes, we have what's called the Board of Governors in Washington, D.C. You've probably heard of Janet Yellen. She's the chair of the board, and before her was Ben Bernanke. Before Ben was Alan Greenspan. They're all appointed by the President of the United States, confirmed by the United States Senate. But Congress said, let's create the Board of Governors. Let's also create 12 independent regional Federal Reserve banks that I'm not appointed by the President of the United States. I'm the President of the Minneapolis Fed. I was appointed by our Board of Directors, Christine's one of them, of local leaders from our region. And Congress's idea 100 years ago was this distributed power. Think about it as a separation of powers, checks and balances. So the reason that I'm here, the reason that we have a Minneapolis Fed is that we are here to represent you in our monetary policy process. So when I go back to Washington, D.C. 8 times a year, part of what I'm doing is speaking about what's happening in our local economy, what's happening in North and South Dakota, in Montana, in Minnesota, in the Upper Peninsula of Michigan, and part of Wisconsin, to bring that local perspective back to that national policymaking process. That's why when I say to you, I want to spend most of this time hearing from you, I mean it. I want you to tell me what's happening in your business. I want you to tell me what's happening in the local job market, what's happening in wages. Because if we look at the national economy, overall the national economy is doing pretty well. The unemployment rate continues to drift lower. It's around 4.3% now. The economy nationally is creating a lot of jobs, which is all good. We want more jobs. We want more people to find good employment opportunities. At the same time, we haven't seen wages grow very quickly. And that's kind of a conundrum for us. We would have expected, as the economy's been creating a lot of jobs over the last few years, we had expected to see wages start climbing more quickly, but they're not. And so we need to understand that dynamic. I've heard already, we did some preparation for this trip. I've heard from a lot of folks that you all are short workers. So I want to hear from that. I want to hear, is that true? What types of workers are you looking for? What kind of pressure is that putting on wages? Because that's going to help us be more informed when we look nationally at what's happening at the national economy. Let me talk about 2 other topics, and then I want to turn it over to you, and we'll talk about whatever's on your mind. So I've been at the Minneapolis Fed for 1.5 years. One of the first initiatives we took on that the bank had some history in, that we really ramped up when I got there, was the issue of too big to fail. So during the financial crisis, I'm literally the guy who bailed out the big banks, okay? My old boss, Hank Paulson, the U.S. Treasury Secretary, liked to joke that 60% of Americans are against torture. Think about waterboarding, right? 60% of Americans are against torture. 90% were against the bailouts, okay? And I'm the guy who bailed out the banks. So this is a very personal thing for me. And my basic message is the biggest banks in America are still too big to fail. If they were to run into trouble, the taxpayers would still be on the hook. And I don't think that's okay. So we spent all of last year talking to the best experts in the world to look at what we can do about it. And we released a draft plan that we call the Minneapolis Plan. It's on our website, that basically will force the biggest banks in America to fund themselves with a lot more equity capital. You know, when I bought a house a year and a half ago, my wife and I did, our bank made us put 20% down. The reason we had to put 20% down is that 20% is designed to protect the bank in case we run into financial trouble. Right? That's the buffer that protects the lender. Well, if we make the biggest banks in America put 20% down on their investments, the taxpayers won't be on the hook anymore. And that's what we need to get toward. So we can talk about that. I just want to mention that that's a big area of focus for us at the Minneapolis Fed. And then the last thing I'm going to mention, one of the big surprises to me coming to the 9th District, this region, was the economy overall is doing pretty well. It's a diverse economy. Most major sectors of the U.S. economy are represented here. I was surprised to learn the extent of the disparities in our region. We've got racial disparities. We have urban and rural disparities, lots of different disparities, in many cases decades or more in the making. And we don't have a lot of good research underlying the causes of those disparities and what potential solutions are. So we at the Minneapolis Fed have announced a major new research initiative to try to unravel some of these disparities to see what can policymakers do about it. We know we can't address them with monetary policy, but if we can come up with solutions that other policymakers can take advantage of, then we feel like that's an important role for us to play. So I'm happy to talk about that too. So with that intro, I'd like whoever got the roving mics to come on out, and I'd love to hear from you. Whatever's on your mind, questions, comments, and I always say, do me a favor and ask me your toughest question. I mean that, because if you're thinking of a tough question, there's a good chance somebody else is thinking of the same question, and I'd rather get a chance to address it than have you all wander off not knowing what the answer is.
If we could have Rotary members only, since there's so many of us, so we can keep the questions to a reasonable amount. And then please wait until a mic comes to you before you start asking your question. Thanks. Raise your
hand. In the front, on the right here, there's a woman over here with the... Thanks for being first.
So welcome to Sioux Falls. I'm
Thank
Susan Randall, a member here of Downtown Rotary, and was delighted and pleased by the leadership of the Minneapolis Fed over the last 10 years in their work focused on early childhood education and its important role in preparing young people to be successful in school and successful in the workforce. We partnered with some of your predecessors trying to change the climate in South Dakota, and we made some success, but we still have a huge, long way to go, and lots of kids on waiting lists to get into, that are low income, waiting to get into subsidized early childhood education. I wonder if you could tell us where the Fed has gone with this initiative and how you see us trying to address it now.
Yeah, thanks for your question, and you're exactly right. So before I joined the Minneapolis Fed, for a long time, our bank did really important work exactly on this early childhood education, saying that this is a very good use of taxpayer resources, that taxpayers get paid back many times over if they invest in early childhood education. Excuse me. So this is a perfect example of the type of policy solutions I think we want to try to develop, where the Fed doesn't control education policy, but if we can do the analysis in a nonpartisan, non-political manner and say this is what the data shows us, then we can equip you and your elected representatives with the information you need to take it forward. And we continue to do a lot of work on this. And in fact, our bank has a little research center also focused on Native American issues. One of the things we recently did are trying to bring our research on early childhood education to tribes, to show them that it's just as important for their kids to be able to get this early start as well. And I think the state of Minnesota is probably even further along in embracing some of these early childhood remedies. And so we just want to keep working, keep trying to get the message out, and we're going to keep doing everything that we can. But again, given our role, we're limited in some sense to doing research, to speaking about these issues, but we're not in a position, like we're not a grant-making authority, et cetera, and we're not allowed to lobby. So all we can do is arm legislators with the data and the analysis, and then look to leaders like yourself to try to take it forward. But we're going to keep doing our part. Others, thanks for your question. Now, I don't believe this is a shy crowd, so.
Mr. Kashkari, I'm Doug Hayek. I applied your efforts on the too big to fail question. It's obviously something that you have a particularly impressive background in dealing with, and I know that you hosted these symposiums last year, and I was fortunate enough, thanks to Christine, to be able to attend a couple of them. As you know, two of the nation's largest four banks have their main office in Sioux Falls. So it's a question of the too big to fail and the potential breakup that could cause would have some pretty significant implications for South Dakota because it does derive a lot of benefit from the fact that these two banks, Citibank and Wells Fargo, have designated Sioux Falls as the site of their main office. I just I've wondered if you had gotten much input on that.
Sure. Well, so first of all, our plan the banks would have a choice. They could either choose to stay as large as they are, and then they would have to be well capitalized enough to protect taxpayers, or they could choose to restructure themselves so that they're no longer systemically risky for the country. And we've done cost-benefit analyses. We've looked at what this will do to the cost of loans and the cost of credit in the economy. You know, you can never make the risk zero. Think about this. Think about the risk of terrorism in our society. You all intuitively know we can never make the risk zero. Right? We pay more. We pay for law enforcement. We pay for metal detectors at the airport. Safety is not free. So we as a society have to decide how much safety do we want and what price are we willing to pay to achieve that safety. The exact same thing is true in financial stability. How much safety do we want to protect taxpayers from future bailouts, and what price are we willing to pay? It's not free. What I would expect to happen if our plan were legislated and put into practice, some of the banks would probably choose, they may have business lines that really benefit from big economies of scale. They may say, well, let's keep that thing separate and keep it full scale. And then other business lines may not benefit so much from economies of scale, and they may choose to restructure. I think the market is better at sorting out those decisions than government regulators are in deciding what's the optimal size of each of these businesses. So I don't know what would end up happening to their operations here. Maybe they would stay here intact. Maybe they'd have a new name. Maybe no change at all. I don't know. But I do think that you all need to know the biggest banks are still too big to fail. And if you're okay with that, then that's a choice that the American people can make. But I feel like our jobs are to give you the information, tell you the facts, and then you can decide how much safety you want and what price you're willing to pay for it.
My name is Lord Boyens. So Sioux Falls is often said to be the economic giant of our state, along with the ag community, certainly. And our small communities are shrinking, if not dying. I'm curious if through your travels and through your experiences, if there's a model out there that maybe we should be aware of going forward to allow Sioux Falls to help our fellow statesmen to maintain their communities and help them to grow and to come along, if you will.
Well, so I get this question a lot as I travel around, our region more broadly, and you're right. A lot of rural communities are shrinking. Their kids are going somewhere else for college and then going somewhere else for their careers. The cities that have done a better job, honestly, I would look to Sioux Falls. From what I can tell, what I've read, you guys are doing about as good a job as one can do in tackling these challenges. The fact is your population is growing, not shrinking. And so what are the communities doing right? They're doing two things from what I can tell. One is there's a strong partnership between local leaders and the business community, so civic leaders and the business community, to try to make the local economy as attractive for businesses as possible. Also investing in amenities so that it's an attractive place for young people to want to return, to have their families here. And then third, embracing immigration. If you look nationally, look at any economy. Economic growth comes from two things. It comes from population growth, and it comes from productivity growth. Productivity growth means educating our workforce so that they have more skills, and it's technology development. But then there's just population growth. And the fact of the matter is the U.S. population is not growing as quickly as it used to because we're not having kids at the same rate that we used to. And so that's math. I always say this to people. You have three choices, and I'm not offering you any value judgments. I'm just describing the math for you. You can either accept slower growth, you can spend a lot of money to subsidize fertility, child care, etc. It's very expensive, or you can embrace immigration. That's math. Those are your three choices. And from what I've read of Sioux Falls, you guys have done a pretty good job of embracing immigration, and that is a source of economic growth and vibrancy in this community. And so my message to other communities is, hey, look what Sioux Falls is doing. Now, you're not a little town, right? This is a much larger community, but I think you guys are doing, from what I can tell, you all are doing a good job in managing the transitions that a lot of our region are undertaking. Now, I know others have questions, but I'd be interested, do I have that right? Am I characterizing Sioux Falls correctly, or am I missing something? I'm characterizing it correctly, okay. You're working it. All right, thank you. So somebody else have the mic.
Hi, my name is Rob Howe. I got a kind of a two-part question, both very closely connected. A lot of us felt the pain of 2008 and 9, and obviously the banking institution had somewhat to do with that. My two parts are, one at the macro level is the banking policy of fractionalizing or selling off mortgages to secondary and tertiary markets seemed to be contributive to that whole fiasco. The second part was the social engineering aspect, where you were talking about connecting with other departments and trying to affect their changes. And the social engineering aspect of that, of maybe putting people in a home that really couldn't afford it. What's your thoughts on that?
Sure. Well, I think there's no question that securitization absolutely added to the crisis. Securitization doesn't have to be bad. There were big abuses going into 2008. People were packaging loans. They didn't care what was in them. There was no skin in the game. People were buying complex securities. They didn't know what was in it on either side. And so there's no question securitization was part of the problem. But I don't think that means we should throw all securitization out. I think that is a source of funding. If done transparently with real underwriting standards, I think it is a useful product that provides more funding to these different markets. And then you're right. I mean, a lot of folks bought home. At the end of the day, a lot of folks bought homes they could not afford, were in mortgages they could not afford. And at the end of the day, it was about bad lending at the end of the day. You know, when people ask me what caused the financial crisis, a lot of things came together. It was a perfect storm in many ways. But if I were to go to the root cause, we all, Americans, shared a nationwide delusion that home prices only go up. I bought a house in California in 2005, right? I was part of the problem. I didn't see it coming. And if you look in American history, the whole U.S. housing market had never fallen at the same time. You thought that, well, New York will be up and San Francisco will be down. Texas will be down, but then the Dakotas will be up, and they'll balance each other out. And that was a fundamental assumption that people just believed was true. When that turned out not to be true, then the whole system basically cratered. And so the unfortunate thing is that human societies, if you look at human history, human societies have these repeated mass delusion events. Whether it was the stock market boom going into the Great Depression or the tech bubble, there are lots of mass delusion events. You can't legislate wisdom. We're going to be stupid again. And so my point is, how do we put in place a regulatory system that doesn't allow the economy to collapse when we or our kids or our grandkids are inevitably stupid again? Sorry, long answer to your question, but there's a lot in there.
Hi, Eric Erickson.
Hi.
Welcome, and welcome, Christine. I bought a house in 2006 in Arizona, so I feel your pain. I did hear a little bit of your interview on South Dakota Public Radio, and I was interested in what you had said about innovation, and that social media is not innovation. And the wage growth we saw with the .com boom was true innovation, and it resulted in wage growth. I'm wondering if you see anything on the horizon that we could expect to result in the innovation and maybe the wage growth we're looking for?
Well, this is a big, complicated topic. A big question mark in the economics profession is why is productivity growth in the U.S. economy so low? It's much lower than it has been in prior decades. And we think, you pull out your iPhone or Twitter or Facebook, you think, wow, all this stuff is happening. Well, some experts say the things that we're creating now, that we're innovating now, just aren't that impactful. They don't really move the needle very much. So if you compare Facebook and Twitter, which seem pretty cool, to electricity or the internal combustion engine or the airplane, it's just not that important. And so maybe that's right. Maybe the stuff that we're innovating now isn't moving the needle in our economy. Or better video games. So we're getting better leisure, but is it leading to a more productive society? That's the question that we're wrestling with. And I have some sympathy for that view, because I personally don't think Twitter and Facebook, to me, the most important innovation in the last decade is not social media, it's fracking. It is having a much more profound impact on the global economy than social media is. And yet you don't hear as much about it in the kind of pop culture arena. So what could be on the horizon? I'll tell you, self-driving cars and trucks have potential to be productivity enhancing, but they're also disruptive, right? For folks who are driving cars and trucks, that could be very painful for them as they try to find out, well, what's going to happen to their job, or how is their job going to change? So whenever we go through major spurts of innovation, they usually lead to disruption, and they usually lead to tough transitions for people who are personally affected by it. But overall, over the long term, society usually ends up being better off. But I don't know. And that's the thing about innovation. We never know until it's right in front of us, and then it was obvious.
Thank you.
Hi.
I want to go back to your comments earlier on immigration. So given our ag-based economy in South Dakota as well as the economy across the nation, what do you see as the impact of potentially reducing the number of immigrants and refugees resettled into our country by up to 50%?
Well, I think, again, just going to math, if a big source of economic growth is population growth, and your population growth slows, either because you restrict immigration or because you have fewer babies, your economic growth is going to slow. And so, again, it's just a decision that as a country we have to make. Do we want economic growth or not? And that's what it comes down to.
Tom Simmons, as a representative for the district from our part of the country, mostly a rural area, I'm assuming that not all of the districts are in lockstep with each other, that there might in fact be disparities with maybe some of the areas from heavily populated areas. I'm interested in knowing what differences you face, what issues you might have in making our concerns at the top of the list as opposed to the bottom of the list.
Sure. Well, when the tough part about monetary policy is that we have one interest rate that we effectively get to set for the whole country. So you can't target a separate interest rate for South Dakota or for Sioux Falls or for Minneapolis. So we're trying to make our best judgments for the U.S. economy as a whole. And we look at a lot of data all day. We get all these reports of all this data that's collected locally and nationally. And the data is interesting, but for me, the data becomes much more meaningful when I'm able to meet people like yourself who can tell me, hey, what are you really seeing in your business, in your community? It makes the data much more meaningful. So again, a few minutes ago, I talked about how the unemployment rate in the country has come down, yet we're not seeing wages climb. So a question that I'm asking everybody is, if you're complaining about you can't find workers, why aren't you raising wages? And that's what we at the Fed are looking for signs of, that tight labor market leading into higher wages. And so to answer your question, I can't promise you that I'm going to say, well, South Dakota or Sioux Falls is going to be what determines monetary policy for the nation. But the information that you all are willing to share with me, I think makes us much better informed policymakers when we make this judgment for the nation as a whole. And so it's a balancing act that we're trying to strive. Thanks for your question.
Hi, I'm Mohammed. I'm a
Where
member
are
of
you?
the.
Sorry. In the back. Hi there.
Hi, Mohammed, a member of the Rotary, And speaking as a first-generation immigrant, I totally echo your point about Sioux Falls being good to immigrants, and I've been here for the last 6 years. But I will say one thing, and maybe you can help out and answer this question. The economy of Sioux Falls has mainly been driven in the last few years by healthcare and by finance and by ag. So there's a particular type of immigrant that comes, and then some of them stay, some of them actually leave. So taking an example of other cities or towns that have diversified their their base as far as going more towards IT and tech, what examples can we take? So, for example, if there's somebody, a young person sitting in California who is thinking of moving, but Sioux Falls is not on their radar for a variety of reasons, how do we make that segment also grow so that we can attract a newer type of immigrant to Sioux Falls?
Yeah, well, it's not easy. I think a town that I would point to that's done a good job in tech is Bozeman, Montana. It's absolutely a tech hub, and usually it starts with one or two companies getting formed and having some success, and then spinning off other workers from that company who then go and start, and a little ecosystem develops. So I know here you have a lot of healthcare. Christine is talking about some of the biotech companies that are here. You're usually going to be more successful in adjacent sectors. So I don't know this for a fact, but let's say if you had no IT here today, it's probably hard to just jump and say we're going to make Sioux Falls an IT hub. If healthcare and financial services are major hubs here today, parallel adjacent sectors are probably going to be where you're going to have earlier success. I don't have a great answer for you other than that, other than some towns have done it, but you got to start with something. So I apologize, I don't have a better answer for you, but it's a tough one. But again, I think Sioux Falls is doing a good job relative to most places that I visit.
Thank you.
Hi.
Ann Hayek. A little follow-up on your just comment about the wages here. There was a recent action by the Minneapolis City Council that took the minimum wage mandatory to $15 per hour. And as we struggle with various things within our community, I, of course, have my own feeling about legislatively mandating that. I'm curious as to what your thoughts are on that.
Sure. It really, the minimum wage, there are winners and losers. And I think policymakers, local politicians who are the ones enacting these generally, need to have their eyes wide open that some people benefit and some people are hurt. If you're in a time of high unemployment and you raise the minimum wage, it's going to be better off for those workers who keep their jobs. And on the margin, it's going to be tougher for people who don't have jobs to find jobs. That's math. Now, if you're at a place of very low unemployment, there probably are going to be fewer losers and more winners because most people already have jobs. And so there are trade-offs. And I'll give you a simple thought experiment. If you don't think raising the minimum wage makes it harder for somebody to get a job, why stop at 15? Why not make it 50? Now, the other side of that coin is, then why not make it 0? And I'm not advocating making it 0 either. But my point is we all need to have our eyes open that there are winners and losers in these things, and people should proceed conscious of that. And there was a recent study done out of the state of Washington suggesting that there may be more net harm to their raising the minimum wage. But this is a point of controversy. Economists debate it over and over again. I think a better way for wages to go up, personally, where there's no losers, is a strong economy where wages are going up because businesses are paying everybody more. And so that's what I'm hoping we're going to start seeing soon, right? We're seeing the unemployment rate go down. We would think we'd see wages going up across the board, but we're not. And so I guess I'd be interested to any of you. Are any of you planning to raise wages in the next year or two? Or are you just complaining about you can't find workers and you're not going to raise wages? Because I can tell you something. I can tell you, if you look at North Dakota in the oil boom, if you raise wages, people respond and you can find workers. So are you really struggling to find workers? If so, the proof for me is you're raising wages. If you're not raising wages, then it just sounds like whining.
I'm Ray Woodson, and my clients, we service people that are issuing bonds like cities, counties, and schools. So our interest is in the quantitative easing and what you see as the likelihood of how that will occur, because quantitative easing will affect long-term rates more than the current Fed rate has not had a lot of impact on us. And will they just roll it off, or what will go into the decision as to what method they'll use when they start that process?
So thanks for your question. So once, in the financial crisis, once the Federal Reserve took interest rates down to zero, some people thought that they were out of ammunition. But instead what they did is they expanded their balance sheet by buying these long-term treasury and mortgage-backed securities, driving down long-term interest rates. So now we have a $4.5 trillion balance sheet. Actually, in June, we put out a very detailed statement saying how we're going to shrink that balance sheet. And basically the plan is just to allow it to roll off very gradually over the course of several years. We don't think it's going to be disruptive to the markets. The markets expect it coming, and it's going to be, we believe it'll be very orderly, and it should be a low-cost way of shrinking the balance sheet back down to a more normal size. Hi.
Hi, Tom Kelly. I think part of the key to this whole raising wages and getting the economy going is around education. Manufacturing is making a huge change over America. I mean, you hear a lot about we're losing manufacturing jobs. The truth of the matter is we're doing twice as much manufacturing in the United States than we were doing 20 years ago with fewer number of people. And that trend is going to continue. But in order to get the wages up and to continue that trend, we need to continue to grow our education and our retraining, because these jobs of old manufacturing of the 50s, 60s, 70s, 80s are changing into what new manufacturing is. And I think that takes a real collaborative effort between the private sector and business people and the education sector and building programs around what they need. And so I think it's a whole different new evolution of how the local business community and education work together. And I think we got some of that going here, but I think we need a lot more of that. And that's going to drive the wages. It's not just a matter of, hey, as a company, I don't want to pay our workers more wages. We just took on a new greenfield manufacturing facility that will be the most automated manufacturing facility in North America. And it's going to take a huge change in culture and education to bring that aboard, and it'll bring a lot better jobs. But it's just a whole new way of thinking, and I think we've got a lot of work to do in that arena.
Yeah, I agree. And I think I'm glad you said that you're doing some of it now. I do see examples of this, and as I travel around, of some businesses partnering with community colleges or the local schools to try to give the young people the skills that those businesses need, so that there's a better matching, so to speak, to fill those jobs. So I'm with you on that. A couple have their hands up here in the front. Oh, over here.
Yes, Dave Eastland, and thank you for being here. The medical costs have affected, some people already, and basically all of us eventually at some point in time. With all the uncertainty that's going on in the medical coverage and the health care, and the economic driver that it possibly can be, what are your statistics and what does your information show if something could be solved or taken care of? Would that get more entrepreneurs into business? Would it help companies? What does your information show?
Well, I think there's no question increasing healthcare costs is a big challenge for all businesses, large and small, and for families that are paying their own premiums, et cetera. So it absolutely is a big challenge for everybody. And go back to the demographics that we were talking about earlier. This just gets harder and harder fiscally to make balance when our population is not growing as quickly as it used to, because generally our entitlement programs are current workers pay for current retirees. And as those ratios go into imbalance, those programs go into the red. So it is absolutely a huge challenge, and if we could get our arms around a healthcare system that's sustainable, that we can afford, I think it'll provide a lot more certainty for workers, for businesses, for everyone, which then, more certainty is good, and it enables people to frees up capital to make investments on long-term development, which I think will be good for economic growth. So it is a huge factor, but as you all know as well as I do, it's a big political challenge. And, it's like Social Security. Social Security, the levers of how you fix Social Security are easy. You can raise the retirement age, you can increase taxes, you can cut benefits. It's literally just a political challenge of how do you get people to agree on which combination of those levers you want to pull.
Jim Schmidt, one of the key factors in economic development for any community has been workforce housing or affordable housing, which is a challenge not only for Sioux Falls but all surrounding areas. Their interest rates have remained fairly stable, but that entry home keeps increasing. From your vantage point, what do you see on the housing market? Because there's a lot of talk about funding being quit for CDBG funds or home funds or things like that. I'd like to get your perspective.
Well, I want to thank you for bringing that up because this topic comes up a lot everywhere. And much to my surprise, and this is the one thing that we've talked about so far that higher wages can't solve. Because if wages go up for everybody, home prices go up for everybody, and then there's still an affordable housing problem. And so what I've been wrestling with, talking to our economists at our bank, why is affordable housing such a challenge everywhere? And the best answer that I have is it's all of our own faults. Because we get our cities to enact little local ordinances that restrict building. And there's layer of regulation on top of layer of regulation that makes it harder and harder and more expensive for new supply to come in. Because you would expect as home prices go up, new supply would come in. But then we have different restrictions on lot sizes, on different amenities, on how many units will allow to be built. And guess who that hurts? It ends up hurting the low-income family that has a job, but that can't afford to get into the housing market. And so this is happening everywhere. So I'm not here to pick on you. It's happening everywhere. We're all guilty of it. But we need to have a hard look in the mirror and realize that we may want to preserve our quaint little neighborhood, but when you add up everybody preserving their quaint little neighborhood, it just drives up the cost of housing, so it's unaffordable for the young family or the low-income family. That's the best answer that I have, unfortunately, but it's a tough nut to crack because it affects all of us.
We have time for two more questions. Pat, do you have a question? Yeah, you do.
No, hold on.
Yeah. You need the mic. This is going around the world, Pat.
They can't hear you on the internet. I'm Pat Cannon. I'm an engineer, so I'll ask a nerd question here having to do with disruptive technologies. You mentioned, well, the term peak demand is now being tossed around rather than peak oil. So it's like the demand is going to peak out at some point. And that has a pretty seismic implication for the fossil companies and the energy industry. As we get grid storage, you mentioned disruptive technologies, as we get grid storage so that our renewables are available overnight, are you guys looking at what that's going to do to devalue the reserves that are in the ground to these companies and how that might change?
So I haven't looked at that. There are a lot of people around the world, 6 billion plus people and 7 billion plus people. We'll see if peak demand. I mean, I remember peak oil, and lots of people predict all sorts of doomsday scenarios, and we're still here, So I don't know. I think my best guess is the price of oil is going to keep going down because technology is going to keep innovating, and so the marginal price of a barrel of oil is just going to keep going down the better they keep developing these technologies. And so, I don't know. We have a surplus of resources. It's certainly possible. All right, last question over here, gentleman on the right. Hi.
Mr. Kashkari, thank you for visiting us today. I'm Todd Ernst, and one follow-up question about wages. And your comment about North Dakota that, what they saw and they were able to attract people, it was certainly true. I think the possibilities of returns were also very true as far as what people believed. And I think some of the dilemma in communities that aren't going like North Dakota, in South Dakota, is you're going to start to impact that. So my question is are you aware of some time in history where actually legislating wage growth has actually led to more economic development, more growth?
I can't think of any off the top of my head, but I don't have. That doesn't mean it doesn't exist. I can't think of it off the top of my head. Again, I go back to a strong economy, driven by innovation, driven by real population growth. We hope will lead to higher wages where everybody's better off as a result of that. And so, I would love to see us get back there where wages are climbing. Inflation is one of our core mandates. Inflation has been coming up short, a little low, relative to our 2% target. That actually matters. You think, well, 1.5 is not a big deal if you want 2. It actually matters that investors believe the Fed can achieve its goals. Because then, if there's a future crisis and we really need people to believe in us, we've earned and established that credibility. And so I would like to see higher wage growth for the workers' benefit, for workers' sake, for town's sake, and for the Fed's sake as well. So let me just say thank you. I really enjoyed this. I appreciate you hosting me here today. Thanks for coming out.